Hello, everyone. Welcome to today's session with HoaQ. Thank you so much for joining us. Today's edition of HoaQ's AMA session, we'll be talking about everything exit. I know people don't want to hear my voice, so I'll just be brief about what to expect and also tell you, for those who don't already know, short things about HoaQ, and then we can kick off with Jason Njoku, because I know that's why you're here. But it's okay. It's okay. So today we're going to be discussing everything exit. We'll be giving you short synopses about HoaQ, and also we'll be sharing with you HoaQ updates that will be taken by Joe, and then we close. Please feel free to ask your questions. Any questions that you may have, please use this comment section. And also we'll be opening the floor once the conversations are done, and anybody that wants to speak can please go ahead to speak. So before we begin, fun fact. There's been more than 50 exits in the past year in Nigeria, Ghana, South Africa, and Kenya. So our top favorites for people at HoaQ, I'm just going to say everybody at HoaQ. So Money Point, acquiring Kobo, Empama, Smile Identity, Cheaper Cash, Fair Money. If you know any other ones, just tell us in the comment section. We want to know. Thank you so much. Also, please share where you're dialing in from so that we know where you're based. I'm in Lagos, Nigeria, and I feel like you can tell because the internet is really very choppy. So, thank you. So I'm in Lagos. With that being said, I'll quickly tell you some short things about HoaQ, and then we shall begin. So HoaQ is a community of creators and operators backing entrepreneurs building scalable businesses for Africa and its diaspora. Our mission at HoaQ is to support founders who are leveraging technology to build economic infrastructure for Africa and Africans. We started HoaQ in 2020, right? And since then, we've deployed about over $3.5 million, and we've invested in over 90 companies so far. And we typically invest from pre-seed to Series A, not beyond Series A, by the way. That's for the club. Currently, we have over 670 members in our community. So if you're not a member, you know what to do. Because aside from sharing deals with you, it's also a network that you're going to need for whatever it is you're doing in future and even now, right? So I'm going to stop talking now and pass it on to my colleague, Nubi, to introduce our speaker for today and also to carry on conversations about exits. Thank you.
Thank you so much, Folake. Can folks hear me? Awesome. So my name is Nubi. I'm one of the community managers here at HoaQ. Do this with Joe, Folake, and Palumi, as well as Zainab as well. So it's a team that's growing, and we have, like you said, about 670 people who've actually at least done one deal with HoaQ since we started this about 3 years ago. And so we're happy to have you guys join us for this AMA. Just for context, we have these sessions as a way to deliver on our goal of enablement. Like HoaQ for us is really about enablement. How do we get angels started when they're in investing journey, to also back founders who are embarking on their ventures as well. So it's how do we get people who've been there, done that, have words of gems to share with us. And so I'm really excited to have Jason Njoku join us today. Jason, if I want to ask everybody else question about Jason Njoku, but just in case you don't know him, he's a founder, the CEO of IROKO TV, and is a self-proclaimed serial entrepreneur. When I saw that word on Wikipedia, I was like, what does that self-proclaimed? I think it's proven already, the works you've proven already. So I think it's a proven serial entrepreneur. A fun fact is that he's actually had a number of ventures and startups before IROKO, so we might touch on that a little bit. He's someone who's actually very active in angel investing. In fact, he started a fund, Spark, a while back, before angel investing became even sexy, to back early stage startups. And so we'll talk about that as well. So with no further ado, Jason, thanks for joining us. It's nice to see your face and hear your voice as well.
You want to see my face? Give me a second there, because I'm relaxing small. It's morning where I am, and there's me relaxing small in bed. But let me actually Let me show you my face. Let you know that I'm real. Hold on one second.
No worries, no worries. So yeah, thanks. Yeah, thanks. And guys, if you have any questions, please feel free to note them down. We'll open the open the room for people to ask questions down the line as well. But yeah, thanks Jason for joining, and I appreciate you joining us early this morning. Yeah. I mean, I've done a good job in the introduction, so I don't know if you want to give it another start. So who's Jason Njoku?
They can Google me. Let's get into the meat and bones. We don't want introductions. Google's that's what Google's there. Do your own research. Actually, so exits are supposed to inspire people, right? Your top 5 exits. You know what's unique about all of those top 5 exits? There's no price. Do you know the price that Money Point bought Copper for?
No, it's not public.
Like, do you know any? Like, so what is the point of it then? Like, how do you become inspired if you don't know what the price is?
Yeah, I guess the point just being like for the Copo guys, like that was an out, like that was an end game or like end of story for them.
So perfect example. I was in London at a startup event, and a guy that I've known for like the last decade or so, he's telling me like, he's in his WhatsApp group. These guys on the path to billion. That's where their $1 billion outcomes. I asked him like, yo, like, do you have like $1 million? Because you don't look like you have $1 million. So he was like, oh no, he doesn't have $1 million. I'm like, then why are you talking about $1 billion if you don't have $1 million? Like, how about you focus on getting $1 million and you get $1 billion? Because you know what, the pathway to get $1 billion, you most definitely must pass $1 million. So stop talking about your fucking WhatsApp group and get that $1 million and stop giving bullshit advice, because that's not right. And I think in the end, we don't have this conversation at all in any way, shape or form. And I think if you start a venture with a view to building $1 billion outcome, it's unlikely. And most likely you're going to end up distorting your chances of succeeding, I think, first and foremost. I think the lack of exits will actually have a massive impact on this ecosystem. Like, it is a systemic problem that no one's even talking about, but it has to be talked about.
Yeah.
4 years ago when I started asking where are the $100 million exits, a lot of people were like, oh, I'm this old guy, gray hair, just because he didn't make it, etc., etc. Like they're some of the young kids of those days when they were raising their big funds, like they were very rude. I don't expect people to be nice to me all the time, but they're very rude. But obviously they will suffer it now, right? Because you can't just raise $20 million and expect to build a $100 million company without a foundational understanding of unit economics. So I think from my perspective, and it's always been simple. It's like, at the end of the day, why are you building companies in the first place? Like, we're primarily in West Africa, right? I assume most people are here. Most people are using startup as a path to improve their lives. If you earn a 200,000 or 300,000 naira a month, you raise $500,000, your life will improve. Will you become a millionaire? Who knows, but your life will improve. And that is why almost everyone in the Nigerian tech scene over the last 3 or 4 years have used raising the funds to either move their family out, get better passports, relocate to better times, just improve their fundamental lifestyle. Let's forget all this like fluffy stuff. We're building this. No. Most people have left Nigeria for a reason. Your startup was a path to that. Now you've improved your own personal situation. What is the next step from an ecosystem standpoint? So the math is really simple. For every dollar put in, you need to get $10 back, right? That's what investors ultimately expect. So when I used to see somebody raising $1 billion, them talking about like $1 billion was put into the Nigeria tech ecosystem. My first thought was that, okay, so $10 billion needs to come back. Where's it going to come back from? Like, where? Like, has anyone really did a math to say, hey, look, these are the clear paths to actually return this money? Because in the absence of that, in about a year's time, you're going to have a situation where all of the investors who pumped money in 2019, 2020, 2021, they will see no path to an exit and they'll stop investing.
Okay. I think I think that we came into this call like
I come in hot. I come in hot. I come
coming
in
in
hot.
hot. Okay, so let's. I mean, we would get to those things, but I agree with you. That this is we talked about. But let's talk about you, like, and why. Because you mentioned again like this, how things are playing out and all. But you were a founder, but then you actually started a venture Spark, to actually back early stage startup. So why did you see the need for that? Like why did you embark on an angel investing journey yourself?
So we started super early when there was a huge amount of enthusiasm for the Nigerian tech space, right? Um, so we started 2012 to 2013. But honestly, what really made me start Spark was the realizations that you could sell secondaries. Like Chico and Moby sat me down and says, yo, you don't have to wait 10 years. You can actually sell some of your shares to incoming investors or various other things. So you can actually make, some money along the path. So you earn a good salary. But if you want to make a quick like $1 million, then you could do a secondary, like a nice thing, right? Now, to my mind, is that, well, actually, that's from an angel investor, that's a great way for you to not have to wait 10 years like a normal fund would be. So you can, invest $50,000, $100,000 in 3 or 4 years' time. You can part sell, take some of your money back, de-risk the investment, and keep on supporting the company going forward, right? And we had this peculiar scenario in 2013 where there were very few companies being funded. There were very few companies even being created. If you go back then, fintech wasn't really a thing, at least in terms of like companies being founded and built and excitement around that. The API ecosystem never really existed the same way as we understand it to exist today. So the kind of companies that were being funded were essentially e-commerce companies, right? Now, I sat there, I guess, not in the epicenter, but I was sort of around the key players, the Sims, the Jumias, etc. And I took a really very, very, very clear view on Jumia like a decade ago. Now, what they're doing is basically like, it doesn't make any sense. The unit economics do not work. I don't care how much money you're raising. You can't raise money and give it away and think you're making up in volume. It just does not work. And let's be clear, like they put $1.3 billion into Jumia. What's the market cap today? $400 million. Do you think that is an outcome which the ecosystem should be proud of? Like, it's not. But again, like at the time, Jumia or the Jumia Group or whatever they were called back then, Rocket Internet, whatever they were called back then, right? They absorbed $1.3 billion, which could have gone to many companies. So they were doing hotels, they were doing, classifieds, they were doing like ride sharing type stuff. They were doing everything. So rather than you finding there should have been like 20 or 30 companies in the e-commerce space, there ended up being one who sucked up all the money primarily. And granted, I think, Congo raised $300 or $400 million as well. So people poured money into e-commerce. I would say between 2010 and 2015, between 2010 and 2017, about $2 billion was poured into e-commerce in Nigeria or across Africa. No, across Africa, about $2 billion. And of that, about $1.3 billion went into Jumia. What's your sense of the e-commerce situation in Africa at the moment? Good, bad, or completely fucking ugly?
Well, I mean, we have payments, but logistics is still broken. So
I said e-commerce. E-commerce. Forget everything. E-commerce. We'll get to payments in a second.
When it comes to work, you have to deliver the thing you ordered, right? So that if logistics is broken, then yeah, it's still broken.
So the use case for e-commerce in Africa just didn't really appear, right? After $2 billion in multiple variations, horizontal, vertical, direct marketplaces, all e-commerce has largely failed, I would say, in Africa, right? But $2 billion was still invested. Do you think anyone's going to raise $50 million for an e-commerce type activity thing today? Of course they're not. Who will give them money? It's dead. That is dead. It just doesn't work in Africa, right? So you can imagine, the B2B e-commerce was a new narrative that people now created to say that this is a bit different. It's not different. It's the exact same thing. The people are still poor. Like, you know, the customers ultimately need to still buy stuff. So I think in the end, like, we keep on making the same mistakes and not really looking at how do we build our own ecosystems and how do we do things which are native to ourselves. So to me, when I think of exits in Nigeria, I'm going to talk about Nigeria. Sorry for everybody else who may not be Nigerian. When I look at the wealthiest people that I know, they all built their companies. They had no concept of selling their company. They had no concept of exits. You know what they did? They made free cash flow and they made lots and lots of profits. That's basically how they built their business. And their shareholders are happy and everyone is happy because, you know what, every year they get their dividends and that's fine. They get to pay school fees. They get to, you know, have a nice weekend wherever they want to have a weekend. Madame is okay. Everything's okay, right? So if you look at the culture of Nigeria, if you look at some of the biggest companies, they're not necessarily even listed.
Mm-hmm.
Some of the biggest companies in Nigeria have no interest in listing. If MTN was not forced to list in Nigeria, do you think they would have listed? Why? Like, they don't need to list. You think MultiChoice, unless you force MultiChoice to list, you think they'll list? Why would they list? Like, an exit is the wrong question to ask. It's why are you creating this company in the first place? And most of the wealth in Nigeria literally sits in the hands of families who basically build big companies. They generate profits for their shareholders in local currency, and they share in local currency. And I was talking to someone yesterday on this. If you look at any other emerging market, at least that I've seen, they're not benchmarking their exits to dollars. So if you look at India, most of the Indian exits have not been US dollar acquisitions from like US companies or outside companies. It's been listed on their local market for local shareholders or local big conglomerates. That is, their exits have been local exits. So if you read anything about any Indian company, they almost never report anything in dollars. It's in rupees.
Mm-hmm.
If you look at their unicorns, when they exited, they all exited on the Bombay Stock Exchange. So it's local. If you look at the biggest, so the most successful country in Africa, essentially South Africa, right? Like, yes, they have these big conglomerates which are bought by big companies, but most of their wealth sits on their stock market. They have $1 trillion stock market. It sits locally. So if you're thinking of exits, if you're thinking of liquidity, if you're thinking of like generating cash, you have to think of in local currency on the local thing. If you see when MultiChoice or anybody else, or even like MTN, when they announce their numbers, it's in Rand. They're not worried about what the dollar is doing. That's not their problem. They are a South African company. They are reporting in Rand. We are the only ones who want to report in dollars.
We be Nigerians.
Yes. It's only Nigerians that I know. So if you look at, again, and these are fundamental questions which go beyond what an exit would look like, right? I think these go to the point of, like, we should respect our Naira and we should tell our story in Naira terms. Because you know what, like, everybody who hasn't grown gray hairs over the last 3 months of like Naira devaluation conversations, like it's a nightmare. Like if you did $100 million in revenue last year, unless you're doubling your business, you're not doing $100 million this year. And who knows what's going to happen next year when if people start to do invasions and stuff like that. So I think the clear thing is that we need to go back to the fundamentals of what it means to be a Nigerian company.
Right.
If you build your company, you generate profits, you share dividends, and if there is an acquisition, it typically should be like a local acquirer or something of that nature.
Right. So, okay, that makes a lot of sense. So if I get you right, what you're saying is that, because again, everybody in this room right now are angel investors, and so there is not like expectation, okay, I'm putting money into this, then yes, I get, like I said, any dollar I put in, I should get a 10, I should get 10 out. So are you're saying like how that will play out will not be the typical or traditional way we come to see exits, but again, the founders should be looking at things like, again, sharing dividends and all. So yeah,
but for example, like, I know, and in the entertainment space, they monetize. They're like, entertainers in Nigeria, they monetize. There's no exits, there's no acquisitions. Like they just make their money, whether that's selling to Netflix, whether that's doing a show in London, like they monetize and they enjoy it today, right? So they're very traditional in terms of their thinking, right? But let me give you a perfect example. So, Spark, they put $25,000 into Paystack. I think it was 25 or 50,000. We put something into Paystack, like 25 or 50,000. I can't remember how much the number was, right? And we made 14 times our money on that. Yeah, fantastic, right? I know people who put the same amount of money into a sports betting company, and they've taken out more than that in dividends. And they still have their shares, and they've taken out more than dividends because the company is doing $30-40 million a year in profits.
Got it. Okay.
It's
yeah. I think it makes sense. Yeah. So I think it's like let us not get married to how returns are made. Like instead of like again the old traditional like so an acquirer comes from the US to buy your company. Like how else can money be made and then you get a piece of that?
You know what? I think it's very very rare. At least, and please, I could be completely wrong at this, but I've spent 13 years in West Africa, right? I can't think of many US companies that have come and bought Nigerian companies.
I mean,
I can't think of many.
No,
but I'm not even talking about internet. I'm not talking about internet services or technology. I'm talking about companies full stop.
Oh, right. Okay. Got it.
Because like in the end, like the most likely acquirer of a company from Nigeria was South Africa before. Like when our banks got big, the people who came to buy were who? There were South Africans who came to buy, right?
Right.
Like when our FMCG looked like it was making sense, it was South Africans who came to buy, right? So it's like you have to see what is a natural way of who are the people who are naturally looking at these markets. They're Europeans, they're Middle Easterns, they're South Africans before you get to America. And that's the history, at least that I've seen, right? So I think, as an investor, if you get married to a point in time when you sell your shares and you make 10 times or 14 times, like I think that may not be the best outcome in the long run. But again, it comes to what the companies are saying themselves, right? So let's say a company raises $2 or $3 million. It doesn't reach what we consider to be venture exit scale, but it's generating $500,000-600,000 a year in profits, right? As an investor, if you put in $25,000 and every year they're sending you a $10,000 check, are you not happy?
Yep.
At least the money hasn't lost, right? Like, at least
yeah. But then I guess there's the argument as to like venture or angel and all, like the upside is always like crazy, I know. So it's like, yes, I could get the dividend that comes in steady, but that's like again like bits and bits versus this like again this will blow and I'm set for life kind of thing. So like yeah.
What's the most likely outcome? I think that's what you need to put into mind. What's the most likely outcome? So if you want that boom, there could also be a bust. It could be boom or it can go to zero. And the most likely outcome is for it to go to zero. But if you put in 25...
But most people know that though. I want to believe that most people that are doing angel investing, not investing now, angel like startups, know that most go to zero.
Sure. So like, I'm sure you've had investments go to zero.
Yes.
And did it feel good?
No, but it's it's part of it. It's part of it, like yeah.
Maybe you're young, you have this energy. I've met your madam, she's very supportive. My madam, she doesn't understand when the money goes to zero. She doesn't understand.
No, but
she does not understand.
She will be needed investing at all if you don't understand the money will go to zero.
I agree, 100%. But I think if you look at the last 10 years of angel investing, it comes in such waves based purely on vibes and enthusiasm, when it shouldn't be like that. So, like, if you look at 2019, 2020, 21, anyone who had X pay stack engineer could raise $500,000 with like just like a presentation, like 4 pages. People rush to put that money in. You're laughing, but
I wish I knew him right now. Is this?
but you know, like, do you think today that's the case? It's not the case today. It's harder today.
Sure.
Why is it harder? It's harder because the market is harder. Because people who are cutting $50,000, $100,000 checks, they're hurting in this current economy, right? And even people in the US, they too are hurting in this current economy, right? Like, I mean, I'm in the US now. Like, people are putting a brave face on, but people are not making the same kind of money they weren't making before. The stock market is down. People are uncertain about their futures. Writer strike is happening. There's just a general level of like, oh, what's happening with this recession thing? So the money has slowed down, and enthusiasm has slowed down. Does that mean people should stop building? That means if you're burning money, how are you going to adjust it accordingly? Because the crazy thing now is that the venture firms, what are they telling people? They're telling people to go and get profitable, to focus on your unit economics. Do you think it's easy to go from the casino to go and start running like 7 or 8% margin retail business? It's not. You can't. It's very difficult, and it takes time to learn those skills. So I see, and I've been saying for the last year, we're going to see probably 80% of the companies that we know today will just go to zero, because they can't build that venture outcome. And if you're dealing primarily in Naira, it's going to be tough, right? So I think if you think of that, I must hammer. Like, I don't know, are you a Yahoo person that you must hammer? Mother must pay. That's not the work. The work is to get a return. And if that return takes 10 years and you're capturing upside from that return, that's okay too. So for me, like, I'm not here to talk. For me, like, any of those exits you mentioned at the beginning, they're not real to me because I don't know the numbers.
Right. Gotcha.
And let's be clear. Like, I have seen deals where it's like they've been sold for $20 million, but like $3 million is cash, and then like, you know, 17 million is like in some like startup equity shares.
Right.
Fuck that. Send money. Send cash. If it's not, see, for me, if it's not cash, then I can go and do what I want with, then it's not an exit. And in the end, the Paystack deal was 80% cash, right? And to investors, it was 100% cash. So it's like, an exit is cash, you need to be liquid. If it's not liquid, then like you're fooling yourself. So to me, I'm actually gonna go and find the information of those deals, and I can bet anything that they're not full cash deals. That a significant amount of equity would have just made the equity part up, and it's not really a real exit.
And so, okay, so I hear you, and so like, I guess just moving to how do we then make for good, like, real exits and all. So because you mentioned again, like, local acquisition, and then so I think someone actually asked a question that they said you had actually talked about listing on LSE, and then how would that come versus say like a Netflix or Amazon coming, or even multi-choice coming to buy IROKO? So like, is there a preferred outcome for what an IROKO exit would look like, or is it just
See, cash is cash. See, right now, if you want to come and buy, I'll give you a good price. It's gonna be, there's no preference. Like, I don't know, man. Like, I've told you this personally. Like, me, I work incredibly hard. So one day I don't have to work. I don't want to work. It's bad for my skin. It's bad for my emotional health. I just want to relax and enjoy life. So if anyone wants to buy, if they're on here, if my customers are on here, please come and buy. I'll give you a good price. It doesn't matter. Cash is cash. Like, for me, being liquid is being liquid. And the ambition, if you are an entrepreneur, is to be liquid. You want to build amazing stuff, but you can't build amazing stuff if you're not liquid, right? So you need to be liquid. And you need to have a very clear view on what the paths to being liquid are. But the number one tried and tested way of being liquid is just to make profits.
Yeah.
And here's the thing, is that like, the wealthiest people in this world, for the most part, I don't talk about old money, not the new tech money, but the old money, they made their money via dividends. The old family money, they made it via dividends. Like, it's all via dividends.
Okay. Let's talk about taking money off the table, because you mentioned at the start of the call that, again, Chika sat you down and said you could do secondaries, you could start cashing out, and again, like I said, significantly improve your life.
I never said cashing out, I said you could take some small money off the table to do one or two things.
Okay, so let's.
I didn't say cashing out.
Okay. So let's talk about that. Let's talk about that because it's a because sometimes I've heard even founders come to meet me and say, Nubi, I'm raising the price round, whether it's seed. Um, um, is it too early for me to take something off the table, or should I go to a Series A and stuff? So I also wonder, since you've been there, done that, and at least perhaps engage with people who have better understanding of these things, like when is it good, or how should one think about taking a bit off? I would say this from both the founders' lens, but also the angel investors. Also, as an angel investor, writing a check into like the angel round or the family and first friend round, do you wait out? Like how long should you wait out? I mean, for HoaQ, we tell people we say, oh, we invest. Sometimes we actually follow pro rata rules to up to Series A, and then we don't go past Series A. But we give people the options to cash out as angel investors to cash out.
It's not be cash out. It's not cash out. It's not cash out.
Okay,
cash out. We're not doing Yahoo here, please. It's not cash out. We're returning some investors. We're de-risking our portfolio. Cash out. Okay, we're de-risking our portfolio. Which one is cash out?
Okay. So again, I'm just curious to hear your thoughts around that, both from founder lens, but also an angel investor lens.
Yeah. So I think first and foremost, look, in 2014 I took 7 figures off the table, right? And it helped me buy a house. Make sure my dad was okay, everything is okay. Having my first child, wanted to buy a house. But I was very public about this at the time, right? So I definitely was able to achieve that. I think what is really important to understand is that.
How did you get invested? How did that even play out? How did that commercial happen with investors and people who have actually giving you money and stuff?
No, so once, it's very simple. Once Chika told me, I told investors that I just got married. I don't have a house. I want to buy a house. In fact, I tried to get a mortgage. No one would give me a mortgage in Nigeria. Again, I wrote about this publicly. And I said to them that, in that case, the company has money. Can a company borrow me money? They said, no, there's no company borrowing CEO money. I says, what shall we do? So they come up with a solution. You can sell some of your shares. I can do it, really? Oh, that's nice. Thank you so much. And I sold some shares. Very simple.
Got it.
But I think it's important to recognize that we'd raised over $20 million at that point.
Mm.
So we were not very early. We were 3-4 years into IROKO's thing, and we'd raised $20 million plus. The crazy thing about IROKO is that when we were just a YouTube channel, we were making, for my room, I was making $25,000, $30,000 a month in profits. So to my own mind, and looking back now, if I'd never taken venture capital, I would have ended up with more cash from IROKO than when I took venture capital.
Mm-hmm. 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 Mm. But still, but for the founder today, so it was for you 3 to 4 years into the journey, and it made sense to sell at that time because there needs to be met. So can it be earlier though? For the founder today, can that happen?
So it's interesting that over the course of the venture-backed history of IROKO, we've sold assets, we've done special dividends, so IROKO they shared $15 million worth of transactions to shareholders. So although IROKO hasn't had an exit, although IROKO has changed quite a lot from different things, we have shared $50 million worth of between deals to take out angel investors, between special dividends, and IROKO has done a special dividend. We sold an asset, we shared a special dividend between shareholders and other kind of transactions. So we've actually done $50 million worth of secondary special transactions, dividends, etc. So now I know how to get money out of sort of startups because the mechanisms are there, right? But I think it always comes down to one, there needs to be a willing buyer, always. And two, it needs to not be a cash out event. It should be I've done one secondary in 13 years of running IROKO, right? Mm. And that was back in 2014. 2014. And since
why was it employee to get some was it employee driven or why?
For me, employees wonderful. They deserve everything they get, 100% of that. But first and foremost, I must take care of myself. I don't suffer the stress that I suffer for other people. I think people are very, very selfish, and I see it all the time. Me, I just tell you that I'm very selfish. So first and foremost, I must take care of myself. It's not I'm not a captain who goes down with the ship. That's not how it works.
Let me flip it as you as an angel. You've basically invested in a number of deals. Have you gotten the chance to get some liquidity out from secondaries and said no, I want to stay in, and or have you actually said yes? And how do you make that call?
So I think the real boom in secondaries have really came over the last 2 or 3 years. Because I know people, and I think fintech euphoria has driven a lot of this, where somebody would invest, and I call them almost like tourist investors, but they're smart at the same time. They're doing like arbitrage. They'd invest in potential YC type of companies. Yep. They know in a year it will go up 20 or 30 times, and then at Series B, and at least in my days, you never used to be able to sell secondaries at Series B. It used to be like a C, D, E type thing, right? So it's like more growth stage investing, right? They will basically flip for like 10 times in like an 18-month period of time. And I saw a lot of that. But it really only came about in like fintechs and other things like that, right? Fintechs, some of the health tech happened as well. So I think the new investors, over 2019, 2020, 2021, they were very, very open to liquidity. So you saw guys who raised like $10, $20 million, and the founders are taking $2 or $3 million off the table, and angel investors are able to cash out and stuff like that. So I think that was an aberration. That's not normal. And I don't think that happens again. That doesn't come back anytime soon.
No, but
it was too much.
Yeah. So, but do you so for you though, like, is it like, how do you think about, again, you like those liquidity? Okay. You said it's a one-off, but going forward, we'll come around. I mean, the club will come around again, where we'll have these secondaries opportunities as well, where I to clear off angels off the cap table and things like that.
So I don't believe that. Maybe I actually don't believe it will come around. I think we're going to be in a funk for the next. We're going to be in the funk for the next until 2030 or something like that, until we build
wait. For how long?
2030. So like the next 7 years. Absolutely, 100% believe that.
No, wait. No startup will be acquired, or nobody will raise a Series C, D, E.
No, I think so. So here's what happened. Like, if you look at 2010 to 2015, look at all of the biggest investors of that period. Yeah. Tiger Global, Intel Capital, Shinovik, Naspers, all of the big companies like AXA and Pernod, who put money into Jumia. Have you noticed something? None of those guys invested in Africa again. None of them.
Yeah, but now we have the Partech and the Ventures platform and all that dry powder. What's going to happen for the next 2030?
No, I think what people are, so first and foremost, the people you just mentioned, I know them, and their deal flow has changed dramatically. Check their deal flow. Check their deal flow from 21 to 22 to 23. Look at their deal flow. It's changed dramatically. Everyone's focused on, well, how do we get liquidity? How do we get exits? Because anybody who was putting it in 19, 20, 21, you're now thinking 24, 25, you need to see your money back.
So, where is the place of angel investing in this reality you just painted now?
No. So in this new reality, I think. So the funny thing is, actually, I think it's the best time now to angel invest. The reason I say this is, one, the founders are going to be more realistic about what they're trying to do. Two, there's no more FOMO. There's no FOMO. Okay, I don't have money. The Naira is at 930. Are you okay? If you want to try and pressurize me, waka, which one is your pressurizing me? I'm not interested again. So first and foremost, you can't FOMO anybody into any crazy deal, right? Three is that everyone's aware of the shit that we're in. So anybody who can build in this environment, for me, is a super founder. That guy is amazing, right? Or that guy or girl, sorry, is amazing. And I think four is that the nature of competition has changed. So in 2021, 2022, if you were trying to do anything in fintech, there was 10 people doing the exact same thing for the most part. if you were trying to do anything in logistics, there was like 10 people doing the exact same thing, right? If you were doing something in this B2B e-commerce weird thing that everyone was doing, there's like 5 of them. Now, if you're doing something new, no one's going to try and follow you because there's not enough capital to support that. So I think the builders in this current environment are building because they want to build. Like I think they're true builders, not because the money is there to build and you can have a good time and you can chill. It's literally serious people who are going to build. So I actually feel that like one, the valuations are better, so you're going to get a better deal. You know, in the end, like your eventual outcome is based on the valuation. So if you put in a 20 or you put in a 2, no matter what the end outcome is, you're going to be good if you put in a 2, right? As long as there's an outcome. So I think first and foremost, like there's that. Valuations are down. I think 2 is that people are much more frugal now in terms of how they allocate capital. So the actual capital efficiency, of all startups right now is the best that I think is the best it will be in the last 10 years. People aren't wasting money on funky stuff. Right? And then I think finally, if you look forward, the realization that I'm trying to turn Naira or CDs or Kenya shillings or Rand into dollars, I think that argument falls away at this point. Because it's like, if you have local angels who are giving you Naira and you're giving them back Naira, whether it's dividends, whether it's special, whatever it may be, like as long as you give it back Naira, it kind of works out over a long time versus what inflation is doing, versus what you can put your money into, etc. Now, because for me, to my mind, it's like anybody who's sitting on Naira right now, anyone who's sitting on Naira right now is looking for a return north of 24%. Otherwise, the money just basically burns away. So I think there's definitely a huge opportunity to start attracting Naira-denominated instruments for local markets, because ultimately the liquidity should come from the local markets.
Yeah. We are at time. I didn't touch like 7 questions I had on my notes here, but I think this was really, really real and was what we needed to hear at this time. So thank you, Jason, for stopping by to drop them gems.
No problem. Thank you. I just quickly, I saw someone saying that like I'm very, very negative. Like I'm not negative. I'm trying to be as real as I can. And I think what's really important is like I've spent 13 years in this market. You know, us old guys like the tires and the from Pago and like the guys from Carbon, we support ourselves because we understand that if you've been in Nigeria for 13 years, operating for 13 years, you can only be humble. Like I'm sorry, like it's unless you've not operated in the same Nigeria with us, or you're doing something that we don't understand how you're making that money, this thing will humble you, and it will settle your soul, and you will look forward and you'll be like, okay, this is my path forward. I see you're smiling. I know we know why you're smiling because you're not with us suffering there in Nigeria. It's fine, but you guys continue.
Thank you so much, Jason. I will hand over to Joe now to wrap us up. But
do we have maybe like one question or from the audience? I don't think anybody else got this chance to ask a question. Maybe we can just allow one question.
Yeah, I think I asked the question. I think the audience. Okay, you ask a question. Yo, go for it.
Can you hear me?
Yes.
Jason, it's nice to hear you again. I was at Mest when you came, and you were your usual self with honest, brutal facts, so on. So it's nice to hear you again. I have a question regarding when you said now is the time for builders. Considering that in Africa, capital is extremely hard to come by, how are builders going to be able to execute in this terrain where, for example, these people are coming out of, let's say, university or a place where they don't have anything on them that allows them to build the sort of stuff that you would want to see builders with, like heads down and continue to build. So how do you think would be a better way to sort of spot these builders when they haven't even done a lot of work that maybe would give the casual investor some assurance that this is something I can invest in?
So I'm actually going to write it. That's a great question, yeah. So I've got this very simple theory of like billion naira startups, right? To my very simple mind, like most of the fintechs could have been wildly profitable without raising any capital. Not the oldest ones. The oldest ones, they needed to like pay fees and do this kind of weird stuff. But the new ones were essentially like very API driven. They didn't need 10 or 20 or $30 million to build what they were building. They probably could have done it with like $500,000, a small, really focused team, and just to build something really cool. And when I say billion naira startups, it's like, you know, can you get to $1 billion naira in revenue? I think most of them can. It may take you multiple years, but you can get to $1 billion naira revenue. And what do your profit margins look like at that level? Is it 25? Is it 30%? If you do $1 billion naira revenue, you're pulling up 200, 300 million naira in profits per year, and you only raise like $500,000. Like why is that a problem? And let's be frank, like most people who just left university who are pretty young, I'd be surprised if they're even earning like 200,000 or 300,000 naira a month. But these are smart, ambitious, they understand problems they're trying to focus on. So I feel that like we've got so caught up in the sort of the capital raising story that we've lost sight that, at least to my mind, some of the most exciting startups that I've come across never need a huge amount of money, especially fintechs. They never need the amount of money that they're raising. I give you the perfect example of PiggyVest, right? PiggyVest, Odin was saying like yesterday that they dispersed 400 billion naira. That means people deposited something, right? So if they dispersed 400 billion naira, that means people deposited 300 billion naira or something of that range, right? Because they made some returns. Mm-hmm. Does anyone know how much money PiggyVest has made? When was the last time you heard PiggyVest talk about a fundraise? Can someone please tell me, like, there's maybe one or two companies that I am more impressed with in Nigeria than PiggyVest, full stop. Very small team, very focused, very customer-centric, built something that people, even till today, struggle to understand what it is, because it doesn't really exist outside of Nigeria. Like, I've never seen it outside of Nigeria. It's something which is very, very unique to Nigeria. Goes to our saving culture, our planning when it comes to big events and stuff like that. But they've built a very big, and I'm fairly confident, a very profitable business. And arguably one of the most well-loved and well-regarded fintechs in Nigeria. And you know what? They never raised $100 million to do it. They never raised $50 million to do it. I have no idea. I have no idea how much they raised, but it wasn't in the tens of millions of dollars. I'm fairly confident of that.
Okay, if I can extend the question a little bit, how do you do competition in this era where maybe you're not supposed to focus a lot on the money? How do you compete? What's the way? Do you have any sort of recommendation for how you compete when you don't have a lot of capital?
Don't compete. Find something where you don't have to compete on. Be a pioneer. That like anytime you're in a situation where you have to compete, you're basically fucked, because it's not really you anymore. It's about like what the other person is doing. So if you feel you want to pay, if you want to charge something for free, and if you want to charge something and the other guy wants to give it away, you're going to end up in a scenario where you destroy the economics of your business. So for me, like any scenario where I see where there's competition, I try to run away from it as fast as possible. And if you notice, like anything which I do in entertainment, I try to keep it as competition-like as possible, because then I can build up my own cadence. I can build up my own, thing. Like, I don't like growth at all costs stress. Like, I don't like stress in my life. So I want to build and focus and build for the long term. And I can do that if there's less competition. Like, if I'm competing with like 10 other guys or gals, then that's just long. That's just like, I'm up, grinding 15 hours a day. Like, who wants to work 15 hours a day?
I have more questions, but I let others go.
Yeah, no, actually, we are really out of time. I'm so sorry. Yeah. Jason, thank you so much for making the time. I saw you were running earlier, so yeah, you're probably up super early. So we really appreciate this, and thank you for just being super honest with us. And there, at one stage, there was over 100 people here. Actually, there's still more than 100 people here listening. So we really appreciate it. If you don't know Jason, you can follow Jason on Twitter. He's quite active on Twitter. I think I followed you on Instagram recently. So he posts a lot about running, family, and a bunch of other stuff. So
no, I never post about. I rarely post about business. It's family and running. Yeah. That's it. Health and family. That's me.
Yeah. It's a pity we didn't even ask you any question about health, but hopefully people are already asking for a part 2. But we're very grateful for your hour. Thank you so much.
No
and
thank you for having me.
We can't wait to see you somewhere in the world.
No problem. Thank you so much.
All right. Thank you, Jason.
Bye-bye.
All right. Thank you all. I figure people will start jumping because Jason is gone. But we have a couple of updates. For folks who don't know me, my name is Joaquin V, and I am the other community manager here at HoaQ. A lot of updates. We have been busy doing a lot of meetups across the various cities that we're active in. We did Lagos earlier this month. For folks who came, thank you all so much for coming. It was a great event, and thank you all for your feedback as well. We did one in Dar es Salaam yesterday. Surprisingly, it was also great. I personally don't know many people in this ecosystem, so it was quite a surprise to see that there are a lot of builders, a lot of investors here. So for folks who were here and joined us last night, thank you all for joining. We have 2 more that's confirmed. We're doing Nairobi on the 14th of September. That is a Thursday. So if you're in Nairobi or will be in Nairobi on the 14th, please keep an eye out for the meetup that we'll be doing. The one that we did in Lagos, we did a sort of a fireside chat with Shola from Brass, who also hosted us. So we're thinking around doing something similar in Nairobi. We'll do something in Paris. So if you happen to be in Paris, please keep an eye out. And we're hoping to do a couple of cities before the year ends. Dubai for sure, because Nubi stays there. Cape Town. We really want to go to the US as well. So yeah, do you also want to organize your own meetup where we haven't done anything? Please let us know. I know there are a couple of folks in New York. We're happy to give you a playbook. We'll give you a stipend as well to just come together and meet other HoaQ members wherever you are. Next slide, please. Yeah, I think this is like the third AMA where we're talking about platform. Platform is the operating system that we've built for ourselves as a syndicate, but also will extend to other syndicates. I think we're at about 98% built. We are really hoping to make it open to existing HoaQ members in the next 48 hours. So for me, I probably won't be sleeping for the next while. Myself, Yao, Nubi, we're really working very hard to get Platform out as quickly as possible. Platform is essentially the OS for communities to come together and investors like HoaQ. We've built Platform because we just didn't find a tool that can help us run HoaQ efficiently. So what's going to happen over the next 48 hours is we will be sending an email. Actually, it'll probably go through Slack for folks to go try it out. We are migrating all the existing members just to go log in. It's still in beta, so please take it easy on us and give us feedback because we haven't really built anything like this before. So if you're going through it and it's a bit sluggish, or it's slow, please take note and share it. We'll have a Slack channel dedicated to platform support, and you can just share your feedback there. The Slack channel is open. Essentially for this is not the Slack channel, this is the office hours. You have a different Slack channel. And so it'll be open so that we can collect all the feedback in one place. And if you've seen the same feedback, there's no point of view. Maybe you can just like add a plus to signify that you're seeing the same thing. We've been also running a survey in the community to get feedback around HoaQ, what's working, what's not working. And if you haven't filled it, we really, really need your feedback. We're only able to get here because we got feedback, so we really need it to move forward. It's closing next week, so if you have time over the weekend, you can even scan it now. It's very short. I think it's like 2 minutes. Please do give us feedback. And yeah, office hours for anything and everything. We have that Slack channel there. Do reach out to us anytime. You probably have somebody you already reach out to, but if you don't have anybody, do use the office hours Slack channel and we get back to you from there. I think, yeah, that's it. We're seeing a lot of people following us on LinkedIn and Twitter and also Instagram. So if you actually don't follow us, please do so. If you're a HoaQ investor who has invested in the company, feel free to add it to your LinkedIn as a HoaQ investor. I think we have over 20 people that have actually added HoaQ as a HoaQ investor to their profile. Please do so. It really just helps people discover us. Same thing with Twitter. Tweet about us, let people know that we do exist. We do these EMAs every month. So, and also Instagram, follow us. We share a lot of updates there. And yeah, we're super excited. More nervous to go live because I personally haven't built a product before. So yeah, let's see how it goes. Thank you all for coming. People are still dropping. Enjoy the rest of your day. We are right on the hour. And yeah, we'll see you in Slack and on Twitter and everywhere else. Thank you all. Bye. Oh, if you want to stay and have a chat, we'll stop recording. So. We can stop recording and be here.